This final video will look at when an investor does have significant influence and when the equity method of accounting is required. Now, for accounting principles viewers, this is your introduction to the equity method. For intermediate accounting viewers of this video, it's a little more advanced, so a little combined information is being given. Just understand when you're watching this, all the information may not be specifically for your area. So levels of influence to review. If you lack of significant influence, that's approximately less than 20%. And I say approximately because you could own maybe 12%, but you could be sitting on the board yourself, so you do have significant influence. So even if it's less than 20, but if you do have significant influence over management, and specifically the board of directors and those decisions, you have to use the equity method. Just remember these amounts, just a general amount. So if it's 20 to 50% ownership, you are thought to have significant influence. That's where the equity method is required. And over 51% or over, you have control. So you're required to do a consolidation. And that consolidating financial statements is not even studied in intermediate. That's an advanced accounting topic. So when you lack significant influence, you have to use the fair value method. It's also sometimes called the cost method. Investment classification is required. If you do have significant influence, the equity method is required. Control and consolidation is required. Investment classification for lacking significant influence, that's trading, available for sale, and held to maturity. If you have significant influence, you're required to use the equity method. You do not classify your classification, your investments into trading, available for sale, or held to maturity. Here are your classifications. The various things that you would focus on using the equity method are a little different than using the fair value method. You're not doing fair value adjustments. You're adjusting for different things. You're adjusting your investment account. So looking at the initial cost, of course, this is an asset. You would debit it. When the company earns net income, if you have significant influence, you're going to know this right away. You're going to have that connection with the board of directors, where the general public who might be using the fair value method will not know how much net income there is until the financial statements are audited and released months after year end. But if you have significant influence, you're going to know this information. So when they earn net income, and net income is totaled at the end of the year, you make an adjustment to your investment account. Net income will increase it, net loss will decrease it. Also, dividend distribution, when the company declares a dividend, and this is really not necessarily the distribution, it's the declaration. It may not have been paid yet. But on the company side, if they declare a dividend, their retained earnings is decreased, so your investment account is also going to decrease. No fair value adjustments. There are going to be adjustments required for depreciation and impairments, and the details of that are in the intermediate accounting class. It's just talked about very briefly at the principles level. Using the equity method, think of your investment asset account as a mirror image to the company you've invested in, to their retained earnings, only yours is going to be at the percentage that you own. So let's say they have $100,000 net income and you own 30%. You're going to increase your investment account $30,000, or 30% of the total net income. Initial cost, depreciation adjustment will decrease it. Share of net income will increase it. Dividend distribution will decrease it. Share of net loss will decrease it. So recognizing investment revenue, this is different than the fair value method. So when you record revenue when the company determines they have a net income or loss. This would be your percentage of the income, even though you did not receive cash yet. With the fair value method, if you think back to how you did that, you recorded revenue when you receive the cash, the interest or the dividends, but it's different using the equity method. This is a true full accrual entry, no cash. It's recognized in proportion to your share of ownership. Then when you do receive either a dividend or interest, cash comes in. That's not when you record revenue because you've already recorded it. This is when you're going to decrease your investment account because the mirror side of that, the other side of that, when the company paid their dividends or declared the dividends, they decreased retained earnings. So your investment account is mirroring their retained earnings account. And this would be your depreciation adjustment. Again, this is looked at a little more in detail what this depreciation actually is. Investment revenue is decreased. Investment in stock is decreased. Make sure you only apply your percentage of ownership to this journal entry. Now, what if you make a change? If you change from the equity method to another method, it is a prospective change, meaning it's kind of like a change of estimate, treated the same way, where you don't go back and restate anything, you just make the change and move forward. The balance in the investment account serves as the new cost basis to determine the fair value adjustment in the future. But if you go from another method to the equity method, you have to make a retrospective change. Now, this terminology, prospective and retrospective, this is more at the intermediate level. So if you are viewing this at the principles level, what this means is a retrospective change is I have to go back and restate my financials as if that method was used all along. Kind of like the same thing you talked about with a change of inventory costing methods. Let's say you go from LIFO to FIFO. You've got to restate your financials.